Hello my friends, welcome to the Financial Prophet. I have a very special show for you today. Today we will discuss the crucial sentiment, fundamental and technical factors driving the market's price action and why the current pullback could transition into a broader market correction as we advance. Now, just a quick disclaimer here, anything I say in this video is strictly my opinion, and I'm not giving any sort of financial advice, nor am I recommending the sale or purchase of any securities. So, last week I wrote an article titled, "You know the correction is coming, right?" It was a very popular article as corrections can be a highly debated topic. I also provided a comprehensive 5-step plan outlining how we can navigate the upcoming correction to protect our portfolios and capitalize on potential downside opportunities as well. However, the truth is that the correction began about 2 weeks ago. Momentum stocks are typically the first to start declining, especially in these relatively short-term market pullbacks. And many momentum stocks recently registered their so-called blow-off tops. If you don't believe me, just look at Cathie Wood's flagship ARK Innovation ETF. Now, ARK had a massive rebound off the April bottom, appreciating from roughly $38 to $80, more than a 100% return. Some of ARK ETF's top holdings include Tesla, Coinbase, Roku, Roblox, Palantir, and other high alpha stocks, many of which, excluding Tesla and several others, have become considerably overbought technically and are even arguably overvalued here as well. Technically peaked at about $80 in mid-July. While it attempted to make a new high in the following session, it failed to move over $80, and a bearish reversal occurred, which appears to be a blow-off top as well. Moreover, momentum has faded and continues to fade. Notice the RSI as it made a lower high during the blow-off top, signaling that the momentum space may be running out of buyers in the near term. Let's discuss a little bit what is happening behind the scenes here, because behind the scenes, it appears likely that the so-called smart money may have started booking more and more profits in momentum stocks and other names as well. Buyers turning into sellers now, and even potential short sellers in the near term. Then there are the algorithms. With the ARK failing to move above 80, it seems likely that there will be more algorithmic selling, which will likely lead to more institutional and other selling in the near term as well. Now, while I am talking about ARKK ETF, this applies to many momentum style ETFs and momentum stocks in general. And of course, there are also retail investors, many of whom may have been chasing this rally in the momentum stocks towards the end. Therefore, we could see increased retail investor profit taking and potentially some shorting from the retail crowd as well. And of course, it's not just ARK. Let's look at some other ETFs and individual stocks. For instance, the next generation internet ARKW ETF appears similarly bearish technically here. We witness a similar blow-off top pattern with a lower high in the RSI around mid-July here as well. The recent black candle is very negative as it illustrates many momentum names attempting to move higher on very bullish tech earnings from Microsoft, Meta, and others. However, they're failing, putting a lower high around the crucial $160 resistance level. And of course, it's not only about the ARK ETFs. Let's look at some individual stocks like Micron, AMD, Nvidia, and many others. Here's Micron for instance. Now, I'm bringing up Micron first because its correction began after it reported excellent earnings about 1 month ago. Now, despite reporting considerably better than expected results and guiding higher, Micron stock has corrected by a textbook 20% since then. First, this dynamic illustrates that not all stocks have to correct together, and certain isolated corrections began a while ago, like, for instance, Micron almost a month ago. Second, this dynamic illustrates that despite excellent earnings and solid guidance, many stocks could pull back post-earnings, as the market has already priced in considerably better than anticipated earnings in the near term. Let's look at AMD here. Now, AMD has not reported yet, but given the parabolic nature of its stock price and the approximate 150% gain from its April 7th bottom, it illustrates that a near-term top is likely near. The recent price action also looks very much like a blow-off top, and I would not be surprised to see AMD correct by 15, 20, or maybe even 25% in the coming weeks, even if the company reports significantly better than expected. Now let's look at the curious case of Nvidia. Nvidia, of course, also skyrocketed by about 125% since its April bottom. Now, however, we see a negative head and shoulders formation in the RSI. In addition, we see a divergence as Nvidia's stock continues higher. The RSI made a lower high recently. This negative technical dynamic also coincides with a potential blow-off top formation that may lead to a considerable pullback in Nvidia's stock. Well, that may be enough of looking at the charts for now. Let's talk about the sentiment a little bit, because the smart money keeps buying protection. Sentiment-wise, again, the so-called smart money, and I'm talking about hedge funds, big institutions, big investors that go long short, they keep buying put option protection, which is essentially the same as taking out insurance for your home before a potential hurricane hits. The Fear and Greed Index has declined to just greed or even neutral recently, but that does not mean that we're in the clear. On the contrary, this dynamic appears to illustrate that momentum and sentiment continue to worsen, which further increases the probability for a near-term pullback or a correction. And looking at the put to call option ratio here, we see that maximum optimism peaked around early July when the put to call option ratio hit an ultra low of 0.61. Since then, despite the continued increase in many equities and stock market averages, the put to call option ratio has continued to climb. That's the smart money buying protection for about a month now. Despite this phenomenon, other market participants, potentially many retail investors, have chased the recent rally to new all-time highs. Remember, the FOMO has been extremely strong lately, which automatically increases the probability of a correction in the near term. Now let's talk about earnings for a minute, because despite having very solid earnings from many bellwether companies, great earnings may simply not be good enough here. And again, while we've seen excellent earnings out of numerous companies, including Microsoft, Meta, Apple, and now Amazon and others, great earnings may not be good enough in this instance. Micron also reported excellent numbers and it guided substantially higher about a month ago, and its stock has declined by about 20% since then. The market has already priced in much better than expected earnings. And we should also consider that many recent estimates got brought down during H1. Therefore, despite some excellent results, the bar was set quite low for this earnings season. Now, I want to talk a little bit about the hawkish Fed, because that could turn into a big problem. But before then, let's talk about Friday's non-farm payrolls number, because it was terrible. The non-farm payrolls came in way worse than expected, registering only 73,000 jobs versus the consensus estimate for about K. Private non-farm employment came in about 20% below the estimates. And the previous month's reading, the private non-farm payrolls number came in about 30% below estimates, despite the government jobs numbers supposedly being much better than expected. Additionally, the previous two jobs reports got adjusted considerably lower, illustrating that the job market is in much tougher shape than previously thought. Now, what does the Fed have to say about all of this? Well, despite the CME Group's FedWatch tool showing a surge to over an 80% probability for a September rate cut, the Fed's consistent hawkishness makes the probability for a September rate cut much lower than 80% in my view. The Fed chair remains stubbornly hawkish, and there are higher than expected inflation readings to consider as well. Therefore, the probability for a September rate cut is closer to 50% in my view, not 80%. This dynamic creates increased uncertainty for the market, and with markets now heavily reliant on the potential rate cut in September, we could see increased volatility in the weeks ahead. Therefore, I believe we should remain defensive in the near term, as markets may have simply come up too much, too fast, and we have mounting sentiment, fundamental, and technical factors pointing to the potential for increased near-term volatility ahead. So due to this near-term, let's say, somewhat bearish dynamic, let's revisit our 5-step plan as it remains in place for now. So here's my 5-step plan. Number 1, decrease risk. I've taken some more profits in several of my high-flying stocks recently, and I may take profits and decrease more risk moving forward. Number 2, increase cash and dry powder holdings. So I've taken 25 to 50% gains in many high-flying stocks. And I also have access to margin just in case a considerable buying opportunity occurs in future weeks. We can also increase our cash positions to 5 to 10% for moderately risk-tolerant investors. Number 3, continue to rotate. I have continued to rotate away from high alpha tech and other more speculative sectors. Instead, I've rotated capital over to more gold and silver, industrials, materials, defense, oil and gas, pharmaceuticals, biotech, and other more defensive style stocks. Moreover, I may increase some positions in defense, pharma, and other badly beaten down defensive type segments in the near term here. Number 4, increase hedges. I have increased covered called dividends and my put option hedges, as well as some collar plays. I may increase more hedges in the near term. Number 5, capitalize on the downside. We have options, inverse ETFs, and other short-term trading vehicles at our disposal to capitalize on potential sector or even broad market downturns. Now, despite the likelihood for some near-term turbulence and transitory increases in volatility that may lead to considerable buying opportunities in the next several weeks, I remain very constructive on the US economy and the market in general, especially in the intermediate and long term. Furthermore, due to an increasingly favorable longer-term fundamental backdrop, I am increasing my year-end S&P 500 target to a range of 7,000 to 7,200. So what can I say? It's a kind of bad news, good news type of report. In any case, I want to thank you very much for watching my profit report. I truly hope that you enjoyed it. And more importantly, I hope that the knowledge you gain here helps you make more informed investment decisions in the future. I would also greatly appreciate hearing your comments, so please join the conversation in the comment section below. If you enjoyed my video, please click like, share, and subscribe to my channel so I can continue creating these highly informative and possibly very profitable videos for you. You can also join the Financial Profit, my exclusive investment community, which is Seeking Alpha's #1 service for proven portfolio profits. So don't hesitate to join our incredible investment community now. Thank you very much for watching. See you next time and have a wonderful day.